Hello. Welcome back to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Well, it's been a tumultuous week, friends. Global markets have spent the week recovering from hawkish news out of the Fed a few days ago. Concerns that they were lightening their balance sheet and increasing rates at a faster rate than expected sent markets wobbling, and Bitcoin has been no exception. We'll take a look at the price chart. We'll see what's going on in the futures market. We'll see if we got the test of our liquidation low that we've been waiting for, and what the effects of that price action would have been on the traders in futures. We'll also look at the on-chain space and see if we're getting signal from there that any new behaviors are surfacing. If you enjoy my content, please give this video a thumbs up and make sure you subscribe to my channel. We've got a lot of new members of our community recently, and I am so grateful for your support. Glad to have you here. So let's get into the charts. Well, we finally got our test of the liquidation low. As we've discussed a few times on this channel, Bitcoin likes to come back down and test the low of liquidations. Usually there are 2 or 3 bounces before support is ultimately found or it's rejected and it becomes resistance. And we've been waiting for an interaction with this level, and we finally got it. So what does that mean? Are we home free now? Will price reverse and shoot to the moon? I don't think so. This chart down here at the bottom is the amount of open interest currently in this perpetual futures contract on Binance. Open interest being a snapshot of all the open contracts. Here on December 4th, it got wiped out hard, about 50% of it taken out in a single day. And it built up heavily after that moment. And it's actually now still well above the highs from that day, even after what happened yesterday. A minimal effect on open interest from the move yesterday from 46.5 down to 41,000. That's not what I was hoping to see. I personally wanted a flushing of the open interest. I wanted to see a significant portion of these contracts forced to close as a result of this price action. And we did not get that. So there's a couple of inferences we might be able to draw from this. The first one is it seems that current aggression is low while interest remains high. So we don't have anyone really pressing the action in one direction or the other. If we had aggressive longs or aggressive shorts, it would be more clear in the data. Like if we look at the funding rate, for example, which we'll check out in a moment, it isn't showing any clear bias. So it seems that there are a lot of traders on both sides of the action right now. And it appears that whatever longs are in the market, and there are some longs in the market, because if there were not, then the funding rate would be showing a clear negative bias, and it isn't. So whatever longs are currently here seem to have their stops far enough away from this low that they weren't tested yesterday. Their stops must be well down here near 40K or 39. Otherwise, we would have seen a greater impact from this price move yesterday, and we didn't. So there's clearly a lot of traders and activity in futures, but the level of aggression that we're used to seeing right now is taking on a different form. Here is the futures funding rate. So this is the aggregate rate across all exchanges, and it helps to signify how much bias is being pushed in the futures market. When you have aggressive futures traders opening positions and helping to push up the futures price, it raises the funding rate. But since December 4th, the funding rate has not been able to get above this 0.01% baseline stamp level. So the way that Binance calculates their funding rate, if it's within a certain range, I think it's like 0.04 to negative 0.04 or something like that. If it's slightly negative to slightly positive, Binance rounds their funding rate up to 0.01%. That's why this is always considered like a default level. Binance right now has far and away the most open interest of any exchange. They're absolutely dominating the market right now. So the way that they calculate their funding rate is of importance, and they default to this level when there isn't a clear bias being demonstrated. And if I show you the Binance funding rate, here it is. You see this clamp at 0.01% right here. This is demonstrating that there isn't an aggressive push by longs or shorts to create a bias. But as we just looked at, the amount of open interest is extremely high. It's higher than it was on December when we got a big move down. And despite the recent action being quite unfavorable to longs, few of them have been closed. If this market was entirely shorts, then the funding rate we just looked at would be negative, but it isn't. This is the important nuance to interpret from the futures data that we're looking at. There are a lot of shorts in this market. It's obvious from the price action and the fact that we're seeing the funding rate held at neutral. There's enough short demand coming in and providing liquidity that it's not allowing the funding rate to get high into the premium level. Another data point to roll into our assessment of futures is the discount between the futures price and the spot price, also referred to as the premium. You may see people on Twitter talking about this, and it's displayed here on these pink and green bars at the bottom of my chart, which don't match my color scheme as of now. Shout out to Permabull Nino, my colleague at Glassnode, for hooking me up with this script. This calculates the difference between the futures price and the spot price for all the major exchanges. And the reason it's important is because, remember, the futures market is at all times adjusting itself to try to trade in tandem with the spot price. And it adjusts the funding rate every few hours to help entice traders to provide liquidity and create market equilibrium in tandem with the spot price changes. When you are seeing a dominance of pink on this chart, a dominance of negative values, it's showing that the price of futures is below the spot price. For that to be happening shows a short bias in futures. The shorts are predominantly in control, but they aren't pushing their aggression so much as to pull the funding rate down. There's enough longs balancing out the books that we aren't seeing funding change. It's a curious market dynamic that we have right now. If you look here in early December on the day of the liquidation and just following it, look at the dominance of the discount and just how deviated it was from the spot price. That is partially the end result of a liquidation. It's like the momentum of all of the cascades helped to shove the price down so hard that it became hella discounted. Well, that discount has been waning as we've gotten away from the liquidation day, but it still dominates, and it shows that the shorts are still active in futures. So as we're still seeing this elevated open interest here, higher than it was on December 4th, basically near all-time highs, and yesterday's price action had relatively minimal effect on it, I suspect that we are still in for more fireworks. I don't think that these bears are done yet. I mean, let's just look at a couple of data points. Since the beginning of the year, Bitcoin is down 10%. This is a monthly candle for January, and it says up here that it's down 10%. This chart is showing the 7-day change of open interest for each exchange. As we are now 7 days into January, this is essentially the year-to-date change. Binance is this blue line, and look, they are up 10% this year. So while Bitcoin price is down 10%, Binance open interest is up 10%. When you combine that data point with this discount regime that we're seeing in the difference between futures and spot, combined with the continued elevation of open interest, I don't think that the volatility is over yet. There was some talk yesterday after this liquidation that this started to look like a bottom. It was right in this moment here that people were saying, wow, this really looks like a bottom. Look how this wick was formed and how we really got this nice V bottom. Like, it was just a matter of a couple of hours. Everyone was already calling for the bottom and moon math once more. But if you just take a step back and look, we're not done yet. And just based on what I'm seeing in the data, it feels like we've got more room to go. Like, it feels like we need to properly test below this wick and find out if this is a support level. I think that we've got some longs with stops down here, and they haven't been tested yet. They were smart enough not to place their stops at the wick. How do I know that? Because open interest didn't change. It changed a little bit. I mean, yes, someone changed their position here, right? A position closed, but it wasn't like this. It wasn't a liquidation event, and it's still much higher than it was on December 4th. The derivatives market is important to keep an eye on right now. I do think that spot is also important, the order books themselves, but I don't want to spend a lot of time looking at those because there's a lot of noise in the order books. But from a futures perspective, I think we've still got some volatility ahead before we could safely say that yesterday was the catalyzing event that released all the tension. It didn't. And the reason why derivatives is so important now, and I think that on-chain is taking a back seat, is because the activity on-chain is extremely quiet. Just look right here at the spent output profit ratio. This is the profit ratio of all spent coins each day, and I have a 7-day moving average on this. Look at how absolutely quiet this is. This is essentially flatlined. It is hugging the break-even point, which means that most of the coins being spent have a very minor profit or loss ratio, which indicates that they are from very nearby prices. If I zoom this back out and you look at the summer months back here in June and July, you can see these heavy dips below the break-even line for spent profit ratio. These are capitulation valleys. These are points where loss realization was at its lowest point. If you look up here at the net realized PnL, this is the dollar outcome of the spent profit ratio. So these two charts look similar in a lot of ways. If you look here in the summer months, you can see these heavy loss realization spikes. This is showing people bailing out of the market. This is panic selling. You know, the real price drop was back here. This is horizontal price action, but we're getting heavy loss realization. This is panic selling. Over here in December, look, this is the liquidation day, this one heavy spike, and look, since then, it's pretty quiet. There's a bit of a loss realization from yesterday, but compared to the December 4th day, it's minor. And broadly speaking, the activity has been very quiet in the last few days, just like you can see on the spent profit ratio. There's also no real change in the spent profit ratio of long-term holders, which helps us to understand that the people holding their coins for 5 or 6 months and beyond are not currently spending them in a notable volume. We do still see loss realization on chain up here in the top right, and while it's been declining from its recent highs, it's still elevated, which shows that coins bought recently continue to be churned around as price is still negative day to day. People who bought yesterday and 4 days ago are underwater today, and they're then spending them to new hands. So we get short-term holder spent profit ratio here in the middle, declining once more, declining as loss realization isn't as high as it was in early December, but is still printing on this chart. We're still seeing several hundred millions of dollars of loss realization each day coming from these short-term holders. But long-term holders who as a group are in profit, are in heavy profit, they are not realizing it at this time. Realized profit is extremely quiet. And if I zoom it out, it's the second lowest level of the past calendar year, except for July, just before the bottom. I'm not saying that we're currently at a bottom just because of this chart, but behaviorally, the profit realization pattern is similar to the way it looked in the summer when we reached the end of the accumulation phase. So one thing to keep an eye on is this realized profit level. If it completely falls down to flatline, to like no activity, that might be a bottom signal. It's something I'll be keeping my eye on over the next couple of weeks. The percent of entities in profit, now entities being individual participants on chain who may have one or more addresses, the amount of them in profit has fallen now down to April 2020 levels when price was around $8,000. This is indicative of the amount of supply that changed hands at the top of the market in November. While we didn't have a lot of spending of older hands, we had a lot of people buying the top, and most of those coins came from within the short-term holder cohort. A couple of videos ago, we talked about this concept of maybe a swing trading behavior on chain, where we saw short-term holders buying coins here in the summer lows and then spending them in October and November from within the short-term holder group. And we know that because we saw a lot of profit taking by short-term holders, but the activity coming out of older groups was very muted. We've gone through studies on this channel looking at that behavior. So we got a swing trade by many short-term holders up into the new all-time highs, and that became a churning of supply, and many of those coins are now underwater. If we look at percent supply and profit, it's around 70%, so about 30% of coins are in loss. This area is very similar to the 70% profit ratio level for supply that we had at the end of the summer. If I zoom out, this 70% profit ratio for the total supply looks to be like a mid-cycle bottom in recent history. See this? It's kind of curious. This is the same level we're at here. Does that mean we're reaching a point where sentiment may begin to turn around? That is possible. We've got some potential bullish indicators lining up in the near term, implying that perhaps we're reaching a local bottom. Now, this isn't a guarantee, obviously. On-chain data doesn't link 100% to near-term price action, but it implies behaviors, and by looking at past levels in history and seeing price action after them, we can get a sense of how those conditions affected the sentiment of market participants. That's how we use on-chain in a lot of ways. And when I look at a chart like this of percent supply and profit, and I look back through the past, and it looks like this level of around 70% in profit has often met like a temporary floor for price. It seems that we're nearing that region region now, and I'd like to keep my eyes closely on this in the near term. I've been asked recently what I'll be watching for to give me a sense that the bullish on-chain dynamics that we talk about are reversing. The primary two groups that I think will help us get a sense of the sentiment of hodlers are long-term holders and illiquid supply. Illiquid supply is right here in the blue, and the price chart up here at the top is colored based on the change of long-term holders. I wanted to show this data point alongside illiquid supply. So when this price line is green, long-term holders are net accumulating. When the price line is red, they are net spenders. As you can see, they were spenders in the bull run of last year, and they were spenders at the recent all-time high, just as we expected. They were also spenders in March of 2020 in the flash crash. Now, if you look at illiquid supply, which is the blue area chart just below, this group has been mostly accumulating. You can see most of their action tends to just be a growth of this supply. But there are 2 or 3 notable distribution events on this chart that I think can inform us about what to look for in the future. One of them is here on March of 2020. This was the flash liquidation crash that happened as a result of a lot of the economic response to the pandemic. On this day, long-term holders distributed, and illiquid supply saw some of its supply move into a liquid state, which means that it was likely sent to an exchange or spent to another hand in some way. They went from illiquid to liquid, and you see their supply dropping on this day. And since this moment, illiquid supply then turned around and started growing. And they didn't really distribute again heavily until April, until basically the Coinbase direct listing day. And that was another moment where illiquid supply rolled over and they distributed all the way down into late May. And they were maybe the first group that I could identify that began accumulating again. They recognized the end of the collapse and they saw an opportunity to buy, shown here on this line, then growing after the fall, here in May 22nd, May 23rd. But curiously, during this fall, so an illiquid supply did help contribute to the market rolling over in April and May. They were distributing, and many of these illiquid hands are likely newer investors. Now, why would I say that? Well, the reason I think that they're newer investors is because of 2 reasons. One, illiquid supply is biased in a way towards new buyers. So if you send coins to a brand new address that has no history on it whatsoever, that address has no spending history. It has a single transaction of inflows, and it gets added to illiquid supply. Now, once that address interacts with any other address a second time, if that other address has activity, we may identify that address as some other kind of liquidity rating. It may get connected to an entity that has a history. There could be a number of things that happen to it that make it no longer categorized as illiquid supply. That's one reason why illiquid supply is important not to watch in a day-to-day fashion. You have to zoom out a little bit and get a sense of the trend of it. Let the data bake in so that our clustering algorithms can be accurate. But illiquid supply is a little biased towards newer buyers. I think when new market entrants show up, it helps to create a spike in illiquid supply because they are new addresses without a history yet. So this group was distributing. And I think that many of these were newer buyers because of the bias I just described, because we're at the top of the market. So there's inherently a lot of top buyers, and also because long-term holders by mid-March were net accumulating again. Coin maturation had already become the dominant MO for this group, for the long-term holder group. And if this illiquid distribution was coming from older hands without a history of spending, if they were the ones selling the top, then this line would still be red because long-term holders would still be net distributing. But we can see that the trend shifted for long-term holders in March, a full month before we started to see the end of the market, before it started to feel like the price was rolling over. So I think that we had newer illiquid investors spending here. So what will I be looking for in the next couple of months to decide if I think that weakness is returning to the market from the hodler class? Because that would give me a greater concern for Bitcoin on a longer time scale, where I would say, hey, my medium term, now to the end of the year thesis for Bitcoin is looking kind of ugly because I'm seeing XYZ factors. What I would need to see is illiquid supply beginning to unwind and long-term holders to begin unwinding. Red price action and red illiquid supply growth, or a downtrend in illiquid supply growth at the same time that long-term holders are distributing. So on this chart, it would look like March of 2020. It would not look like this, where illiquid supply is going down, but long-term holders are not spending, because that suggests that many of these investors here were relatively new and they just didn't have spending history. So let's bring together everything we're looking at right now. At the time of recording, price does look weak, but we know that on-chain is showing continued accumulation by the long-term, strong-handed hodlers that make up the majority of supply. What I will be looking for going forward is if we start to see weakness from illiquid types at the same time that long-term holders are distributing, like we did in March of 2020, where they showed weakness in the same way that illiquid hands did. If I see this kind of a pattern, it will give me more alarm that I'll be concerned that hodlers will be looking to spend out of their positions. But these groups tend only to spend at high prices. So my expectation as of now is that they will hold firm. But as many of you have been asking me what I'm looking for as an invalidation, that's the primary one. And as we pointed out, yesterday's price action finally provided the proper test of the liquidation low that we've been waiting for since this day. But it didn't seem to have a huge impact on the amount of open interest currently standing in the market, which says to me that there are a lot of traders with stops up here and down here. And we have not yet tested either of those groups. So I expect that this will not be enough to consider a bottom in. I think we may need to go lower. That, or the bulls need to step in and show us what they're made of. The bears have been controlling the price for the last month. Yet despite their best efforts, they haven't yet been able to produce a serious liquidation event that took out this level. Right now we're watching an epic battle in the futures market between bears and bulls, while the rest of the market is extremely quiet and waiting on the sidelines for action. Now, it is possible that we are testing this area right here, and it seems like a pretty important support area, if you ask me. There are numerous places where this price level was important throughout the year, and I'd like to see what the outcome is of us testing this level. Because I suspect that if we get below my little green box, that we would have a month at least of ranging in this area, between 30 and 40, and no one wants that. But as my friend Albie on Twitter has pointed out, we're just taking it level by level. Right now, we're between 40 and 52. Until this level is broken, this is the boundary of our playground. If we get below this green box, we have a new range to play in. If we get above 52, we've got a new range to play in, and the process starts all over again. So it's important to keep your perspective zoomed out, not to get too wrapped up in the little intraday chop that we can experience as part of being involved with Bitcoin. It is a massive ranging beast. And while I like to talk about expectations for the future and projecting many months ahead, the actual assessment of the markets comes from the data in real time. And at the moment, we are level hunting. Follow me on Twitter at TXMC Trades. I post a lot of my analysis on there and announce all the content I'm involved in as well. The market is telling us to keep our hands folded and observe, to wait for a direction. So that is also my approach for now. On-chain is not showing a clear direction, and the futures market has a lot of pressure built up that we're waiting to see a resolution for. Seeing as today is Friday and the weekend is a lower liquidity environment generally, it's possible we get some chop over the next couple of days. The December 4th liquidation happened on a Friday evening. So while many people expect weekends to be quiet for the traditional markets, that may not be true for Bitcoin. We'll give it a couple of days to play out and we'll talk again early next week. I will be producing the Glassnode Week On-Chain video on Monday, so the chances are we won't make another video for this channel until after that, probably Tuesday, Wednesday at the latest. If you have any questions or feedback for me, make sure you leave it in the comments below. I hope you have a wonderful weekend. We'll talk again very soon. Cheers, friends.